Hey everyone, welcome to the channel. Great to have you here. So today I'll be making a video. I'm breaking down the 2026 market outlook, why the global economy is expected to stay resilient, how AI and policy support play a role, what to watch in stocks, bonds, currencies, emerging markets, and commodities like gold and oil, and what all of this means for your everyday decisions around saving, borrowing, and traveling. So this video is just for educational purpose. Please do consult your financial advisors before making any investments. All right. So let's start. 2026 is shaping up to be resilient. Think steady growth powered by AI and supportive policies. Even while politics and inflation keeps things messy, today I'll break down what that means for stocks, bond, currencies, emerging markets, and everyday decisions like saving, borrowing, and traveling. So here's the headline. Global growth is expected to continue in 2026. Two forces are doing the heavy lifting. That is massive investment in artificial intelligence and generally supportive government policies. But there's a catch. Let's see what it is. Productivity looks better and demand for tech is strong. Yet job growth and wages may be slower. What does this mean? The economy overall keeps moving forward, but not everyone feels it equally. All right. Stocks. Okay. Stocks are expected to see strong gains globally, including in developing countries. The US remains the growth engine, thanks to an AI supercycle driving record spending and earnings. There's even a price target for S&P 500 that'll be around 7,500 by the end of 2026. Volatility, the bumpiness of markets should stay moderate, roughly in the range of 16 to 17. So ups and downs continue, but not extreme. Government bond yields, it's the interest you earn. They are likely to drift higher into the year end. Target ranges look like the US will be around 4.35%, Germany about 2.75%, and UK approximately 4.60%. Most central banks aren't expected to cut rates much. They are basically on hold. In the US Treasury, demand may start, the year shaky, with more price sensitive sectors or more price sensitive investors rather in the mix, but is expected to settle down over time. What will happen in corporate bonds? The extra yield companies pay over governments, called the spread, should widen a bit. Investment grade spreads up to 15 basis point, wherever the high yield up to 30 basis points. That means slightly higher borrowing costs for companies, but overall credit market is expected to be resilient. The US dollar could soften compared to 2025. The euro may do well, and emerging market currencies, especially in Latin America and EMEA, which is Middle East and Africa, Europe, could improve. APAC, which is Asian Pacific countries, looks more neutral. Meanwhile, gold and Bitcoin have been rising, reflecting ongoing worries about currency debasement, basically losing purchasing power over time, and concerns about central bank independence. After a volatile 2025, emerging markets look steadier in 2026, with growth likely to continue at a similar pace. Fading tariff risks, easier monetary policy, and ongoing tech investment help. The main risk would be if US inflation surprises higher or AI investments don't deliver. Emerging markets could see sell-offs and weaker returns. Gold remains a standout. There's a bullish forecast near $5,000 per ounce by the Q4 of 2026, supported by central bank buying. Oil is the opposite story. Supply is expected to outpace demand, pushing prices lower unless producers cut output. Brent crude is to be around $58 in 2026 and $57 in 2027. Why is the optimism? 2025 turned out stronger than feared. US tariffs didn't hit supply chains or inflation, okay, as much as expected. Policies stayed supportive and AI's investment surged, but imbalances emerged. Productivity up, hiring and wages more sluggish. What could go wrong? Uneven central bank moves and policy shifts. Heading into US midterms, AI momentum could slow if returns disappoint, and growing markets polarization. Bigger gaps between winners and losers could intensify. A surprise in US inflation could pressure both emerging markets and bonds. For investors, investors can expect growth led by tech and AI, but stay diversified. Polarization means some areas will outperform while others lag. For savers and retirees, slightly higher bond yields can improve income, though existing bond prices can dip when yields rise. For borrowers, don't bank on big rate cuts. Loan costs may stay elevated. Travelers or importers, a softer dollar can make foreign travel and imported goods pricier, and lower oil helps with fuel and shipping, though it's not the only factor. So that's about it. Thank you for watching this video. If you like, please hit the like button and subscribe. Thank you.